There is a version of broke that banks absolutely love, not the kind where you have nothing left, not bankruptcy, not total collapse. They prefer something much more profitable. They want you functional. They want you working. They want money flowing through your account every month. Just not enough money to feel safe. Because there is a very specific line in your financial life where everything changes. And once you cross that line, you stop being profitable for them. That number is not $1 million, not even six figures, it's 20,000. $20,000 sitting quietly in a savings account can completely transform how you experience money, stress, and power in your daily life. And the moment you reach it, something strange happens. You become less useful to the system that makes money from your instability. Let's start below that number. Imagine waking up every week doing mental math. Can I afford gas and groceries? If I pay this bill now, will something else bounce? How many days until payday? Every unexpected expense feels like an alarm going off. Car repair, medical bill, broken appliance. Each one isn't just inconvenient, it's a full-blown financial emergency. You're one bad month away from credit card debt, one job loss away from panic, one unlucky moment away from a spiral that takes years to climb out of. This isn't a rare situation. For a large portion of people, this is normal life, and it keeps them in a constant state of low-level stress that never fully switches off. But there is a threshold where that stress drops dramatically. A point where emergencies stop feeling like disasters and start feeling like inconveniences. That threshold sits around $20,000 in savings. Not retirement money, not luxury money. Just enough to create breathing room. And once you hit it, everything begins to change. Life below the line. Below that $20,000 line, money isn't just numbers. It's noise, constant noise. It follows you into the grocery store. It sits in the back of your mind at work. It shows up when you try to fall asleep at night. Every decision carries a small calculation behind it. If I fill the tank today, can I still cover groceries? If I pay this bill early, will something else hit before payday? What if the car makes that noise again? Nothing has to go terribly wrong for stress to build. All it takes is one unexpected expense at the wrong time. A repair, a medical bill, a broken appliance. When savings are low, every surprise feels like a crisis because there's no buffer to absorb it. The cost doesn't just hit your wallet, it hits your nervous system. You begin to live in a defensive posture, always reacting, always adjusting, always trying to avoid the next financial hit. And when you're in that state long enough, you stop making decisions based on long-term benefit. You make them based on immediate survival. You choose what solves the problem today. You postpone what helps you next year. You avoid risks even when they could improve your situation. It becomes a loop. Low savings creates stress. Stress creates reactive decisions. Reactive decisions make it harder to build savings. And around you, the financial system quietly adapts to that reality. Fees appear when balances run low. High-interest options become more tempting when there's no cushion. Short-term solutions replace long-term planning. It isn't that people are careless. It's that operating without a buffer changes how every decision feels. But there's a tipping point. Not a massive one. Not a life-changing windfall. Just enough saved to create distance between you and the next emergency. For many households, that number lands around $20,000. At that level, the dynamic begins to shift. Not instantly, but noticeably. Emergencies stop being catastrophic. Time pressure eases. Decisions become calmer, and something else happens too. You stop being the kind of customer financial institutions profit from the most. When you stop being profitable, once savings reach a certain level, something subtle shifts in the relationship between you and the financial system. When your balance is low, every transaction carries risk. A timing mismatch between deposits and payments can trigger fees. A surprise expense can push you toward high-interest borrowing. A shortfall can turn into long-term debt. From the outside, it looks like ordinary banking activity. But underneath, many financial institutions earn significant revenue from exactly those situations. Overdraft fees, for example, generate billions of dollars each year. They happen when an account dips just below zero and a payment still goes through. A small shortfall can trigger a large fee, and if several payments hit at once, those fees can stack quickly. With a substantial buffer in savings, those moments become rare. There's enough room to absorb timing gaps and unexpected charges. The account stays positive. The fee never triggers. Another revenue source comes from urgency. When money is tight and an expense can't wait, the fastest options are often the most expensive ones. High-interest credit cards, short-term loans, financing with steep rates. People don't choose those options because they want to. They choose them because they need a solution immediately. But when savings exist, urgency fades. An unexpected bill can be paid directly. There's time to compare options. There's space to negotiate or delay a purchase. Interest payments shrink, fees disappear, the household becomes less reactive and more deliberate. Even routine account charges can change. Some banks waive certain fees when balances stay above specific thresholds. Maintaining a higher balance can quietly eliminate monthly charges that would otherwise accumulate. None of this requires extreme wealth. It simply requires a cushion large enough to absorb normal disruptions. And when that cushion exists, financial decisions begin to look different. You're less likely to accept the first offer, less likely to rush into a bad deal, more likely to wait, compare, and choose. That shift affects not just your bank account, but your mindset. Below the threshold, decisions are driven by scarcity. Above it, they start to be guided by choice. The psychology shift. The most powerful change that happens around that savings threshold isn't purely financial, it's psychological. Below a certain level of savings, most decisions are made under pressure. Every purchase feels like it needs justification. Every unexpected expense feels like a threat. Every risk feels dangerous because there's no safety net if it goes wrong. This creates a mindset shaped by scarcity. In that state, the brain is constantly scanning for problems. It's calculating, adjusting, worrying. Even small financial choices carry emotional weight because the margin for error is so thin. Opportunities that require patience or short-term sacrifice become harder to consider. Switching jobs for better long-term growth feels risky. Negotiating pay feels uncomfortable. Walking away from a bad situation feels impossible. When savings reach a meaningful level, that pressure begins to ease. Not because life becomes perfect, not because expenses disappear, but because there's time. Time to think. Time to compare options. Time to recover from a mistake without immediate consequences. A financial cushion creates space between an event and your reaction to it. Instead of reacting instantly, you can respond deliberately. That shift changes how people approach work, spending, and opportunities. With a buffer in place, a toxic job becomes optional rather than unavoidable. A better opportunity can be considered without panic. A negotiation can happen without fear of immediate loss. The same external situation can feel completely different depending on whether there's savings behind it. Without savings, every decision feels urgent. With savings, decisions regain flexibility, and flexibility changes behavior. People become more selective, more patient, less reactive. They can wait for better deals. They can walk away from unfavorable terms. They can plan beyond the next paycheck. That psychological stability often leads to better financial outcomes over time. Not because income suddenly increases, but because decisions improve. And those improved decisions compound. Building the first real cushion. Reaching that savings threshold can sound overwhelming, especially if starting from zero or from debt. But the path toward it is usually less dramatic than people imagine. It's built from small, consistent moves rather than sudden windfalls. The first step is simple awareness. Look at the flow of money coming in and going out each month. Is there any gap at all between income and expenses? Even a small one matters. If there's a surplus, that becomes the starting point. If there isn't, something has to change. Either expenses decrease, income increases, or both. There's no shortcut around that basic math. Once a gap exists, consistency becomes more important than size. Automating savings can make a significant difference. Moving money into savings automatically when income arrives removes the need to make the decision repeatedly. It turns saving from a choice into a habit. Treating savings like a required payment helps reinforce that habit. Not something left over at the end of the month, but something planned from the beginning. Just like rent or utilities, windfalls can accelerate the process. Tax refunds, bonuses, or unexpected gifts don't have to fund new spending. They can strengthen the buffer instead. Each addition shortens the timeline. It can also help to remove one recurring expense that doesn't add meaningful value. Even a modest monthly amount redirected towards savings builds momentum over time. At a few $100s a month, progress may feel slow at first, but months accumulate. Years pass regardless. The difference is whether that time results in a stronger financial position or the same starting point. As savings grow, behavior often changes naturally. People become more attentive to spending, more motivated to increase income, more focused on maintaining progress. Momentum builds. And when that threshold is finally reached, the effect isn't just a larger number in an account. It's a different experience of money entirely. Stress levels often drop. Decisions become calmer. Opportunities feel less risky. The cushion doesn't eliminate all problems, but it reduces how fragile everything feels. When the game changes. Reaching that savings threshold doesn't mean the journey is over. It means the rules start to feel different. Before that point, most financial energy goes into defense. Avoiding fees, managing timing, reacting to emergencies, trying to keep everything from falling apart. After crossing it, some of that energy can shift toward offense. Instead of constantly repairing damage, you begin to build. Savings stop being just a shield and start becoming a tool. With a buffer in place, unexpected expenses can be handled without derailing everything. That alone reduces the emotional strain tied to money. But the more important change is optionality. When there's breathing room, decisions can be made from a position of strength rather than urgency. You can take time to compare offers, wait for better opportunities, negotiate without feeling trapped. A job that isn't working out no longer has to be endured indefinitely. A better role can be pursued without immediate panic. A period of transition becomes manageable instead of catastrophic. That flexibility can influence nearly every area of financial life. Large purchases can be approached more carefully. Contracts can be reviewed more critically. Opportunities can be evaluated for long-term value instead of short-term necessity. The savings itself may still sit in a simple account, but its presence changes behavior in ways that compound over time. And once that foundation exists, additional progress often becomes easier. Future raises can be partially saved instead of fully absorbed into lifestyle changes. Unexpected income can be directed toward longer-term goals. Investing becomes more accessible because there's already a safety net in place. What began as a defensive measure gradually becomes a platform for growth. That's why this milestone isn't the finish line. It's the point where financial life becomes more stable, more deliberate, and more flexible. The shift isn't dramatic in a single day. It unfolds gradually as decisions improve and stress decreases. But over time, the difference between operating without a cushion and operating with one becomes clear. And once you experience that difference, it's hard to go back. At the end of the day, this isn't really about a specific number in a bank account. It's about what that number represents. Below a meaningful savings cushion, life tends to feel reactive. Decisions get made under pressure. Unexpected costs carry outsized emotional weight. There's very little room to pause, think, and choose. Above that cushion, even if nothing else changes immediately, the experience of money begins to shift. There's space to handle problems without panic. Time to consider options. Room to recover from mistakes without long-term damage. The difference isn't luxury. It isn't early retirement. It's stability. It's the ability to absorb a setback without everything unraveling. It's the freedom to walk away from a bad deal. It's the confidence to make decisions based on what's best long-term rather than what's urgent right now. A strong savings buffer doesn't solve every financial challenge, but it changes how those challenges feel and how they're handled. Instead of living from one surprise to the next, the household begins to operate with intention. Instead of constantly reacting, it can start planning. And once that shift happens, the focus can move beyond simple survival. From there, wealth building becomes possible. Opportunities become easier to pursue. Stress becomes more manageable. It's a quiet milestone, but a powerful one. Because the goal isn't just to earn more, it's to create room between income and obligation. Room to think, room to choose, room to adapt. Once you understand that, the path forward becomes clearer. The question isn't whether progress happens overnight. It's whether each step moves you closer to that breathing room. And once you reach it, everything begins to feel a little more stable. That's where real financial momentum starts.